After over 30 years of low, stable inflation, investors are questioning whether the U.S. has reached a structural inflection point. As is typically the case with critical economic topics, the inflation discussion is much more nuanced than some commentators imply. In this call, we will address the recent rise in inflation indicators, the various cross-currents investors need to consider in assessing inflation risk, the outlook for key drivers of inflation, and the investment implications. Now, our analysis leads us to a few key points. 1. Inflation has been undesirably low for much of the last decade before the pandemic struck. Hence, higher inflation within limits is actually a good outcome. 2. It's clear that base effects, transitory supply chain issues, and the resurgent economy are going to deliver elevated inflation readings for potentially a few more months in 2021. This increase in inflation was widely expected. What was not expected was that supply chains would still be disrupted and that rehiring workers would be as complicated as has proven the case so far. Number 3, labor markets will be the key to assessing how enduring higher inflation will be. We expect the data from August through year end of 2021 to give us the transparency we need to make a longer-term call. And 4, our base case view is that current elevated levels of inflation are transitory, as multiple Fed speakers have indicated. However, we do believe the probability of inflation being sustained at or marginally above 2% has increased significantly. If we are correct, it seems highly likely that interest rates in the United States will need to rise, and that we could see the 10-year yield approach 2.5% to 3% in the next 1 to 2 years, effectively doubling from current rates, with significant implications for investors across asset classes. A critical variable that is required to lead to a sustained increase in inflation is a de-anchoring of inflation expectations. The reality is that for the last 30 years, inflation, as measured by the Personal Consumption Expenditure Index in the United States, has remained below 3%. Even if we do cross this line in 2021, it will take more than a few months to de-anchor expectations that resulted from 30 years of actual experience for American consumers. Stable durable goods prices have held inflation down for the last 3 decades. Since the early 1990s, service inflation has actually compounded about 3.1%. The pandemic destabilized the established norms of consumption in the United States. Households that had historically spent significant amounts on services, such as dining outside the home, travel, and other leisure activities, found that this was no longer an option. They shifted their spending toward goods, creating a positive demand shock for goods. At the same time, there was a negative supply shock in many cases. Service prices were hit by a negative demand shock while good prices were inflated. And you can see this at the far right end of the chart. However, the disequilibrium in supply relative to demand for both services and goods is unlikely to persist for long. Economists almost universally forecast elevated inflation for the second quarter of 2021 based on the base effects from the prior year. However, the actual CPI headline numbers were 0.6% higher than expected in April and 0.3% above expectations in May. The foreseeable part of the increase largely resulted from sharply lower prices in 2020 as demand collapsed across large swaths of the economy. However, the surprise on the upside resulted from other sources. In May, used cars, airfare, and auto insurance drove much of the CPI increase. The airfare increase reflects a normalization after fares were slashed in 2020 to attract passengers. Auto insurance pricing was weak in 2020 as miles driven fell sharply. Used car prices reflect the surge in demand for private transportation through the pandemic, semiconductor shortages for autos, and the unfortunate decision by rental car companies to sell fleets of cars in 2020 that then forced them to replace their fleets in 2021 when demand recovered. All of these factors are likely to dissipate early in 2022. So what's the outlook for inflation? Well, one reason to expect inflation to remain higher than in the past is that demand for consumption is likely to remain very strong through 2022. American households have accumulated over $2 trillion of excess savings relative to historical run rates. As economies around the world reopen, we expect a surge in spending on travel, leisure, and other services that will then lead to more job creation, which then leads to more consumption, creating a virtuous circle. One reason consumer savings are so high is that the U.S. federal government has injected 26% of GDP into the economy through fiscal stimulus since the pandemic began. This is 2.5 times the total amount of stimulus provided in the global financial crisis and is largely supporting household spending and balance sheets. The assistance from the federal government is still flowing. Unemployed workers are currently receiving $300 per week of unemployment insurance benefits from the federal government on top of their normal state-provided benefits. While 25 states have rescinded these benefits early, they continue to flow to a sizable majority of citizens. The Biden stimulus plan also included a new child tax credit that is up to $300 per month per child through the full year. This benefit is available to all households with 2 workers earning less than $150,000 a year. And finally, although it has not been legislated yet, we expect a sizable infrastructure investment program to be signed into law before year-end that will inject even more stimulus into an already hot economy. The infrastructure investment is critical, in my view, as it would potentially raise long-term productivity growth, which increases GDP potential and income potential for American workers for years to come. Labor market disruption is also adding to inflation pressures. This point is very important, as the labor market will be a critical factor in determining whether increased inflation rates are transitory. Job openings, as measured by the Job Opening Labor Turnover Survey, or the JOLTS survey, are at a record high of over 9 million positions, as shown in green. In blue, we have shown new hires from the same survey, which are aligned with the strong, yet below consensus non-farm payroll readings of the last 2 months. One very important takeaway from the pandemic has been how much easier it is for companies to fire people than to hire them. Employees who were laid off over a year ago have in many cases found other jobs or even relocated. This leaves their former employers to start from scratch recruiting new workers, many of whom require time to onboard and train. Compounding the hiring challenge, approximately 3.5 million people departed the labor force since the pandemic began, according to the Bureau of Labor Statistics. There are a range of reasons for these departures, but my base case is that the vast majority of them are temporary and are the result of a combination of factors including, but not limited to, the need to care for children not currently going to school, caring for elderly relatives who are at risk from COVID-19, fears over individual health related to comorbidities or other factors, and in some cases, the ability to derive a higher income from unemployment benefits than from their previous job. Now, over the next 3 months, going into the fall of 2021, we will see most, if not all, of these factors fade. Vaccination rates have decelerated as of mid-June, but the U.S. has fully vaccinated 45% of the population. By the beginning of September, at the current pace, another 100 million doses of COVID-19 vaccines will have been administered, implying about 60% of the population will be fully vaccinated. Around September, schools across the country will be fully back in the classroom, with many of the students vaccinated as doses are approved for younger use. Finally, in early September, the extended and expanded unemployment benefits will expire nationally. While the official unemployment rate for May was only 5.8%, we estimate that the true unemployment rate is actually about 8.6%, if we add in the people who are temporarily not in the labor force. This implies that the recent challenges employers have faced in filling open positions are likely to fade quite rapidly through the rest of the year. As vaccination rates increase, we have seen empirical evidence that job growth increases as well. Once it is safe to return to work, people generally prefer a stable income driven by their own labor to unemployment benefits that could be reduced or eliminated. This chart shows that as vaccination rates move higher to the right on the horizontal axis, the percentage change in employment relative to population, shown on the vertical axis, increases as well. One last factor that adds to inflationary pressures is ongoing quantitative easing. Central banks around the world continue to inject massive amounts of liquidity into the economy and markets through securities purchases. The Federal Reserve indicated on June 16th that it has now begun to talking about tapering, which implies that in the foreseeable future, asset purchases might be reduced in size. But for now, the monetary policy spigot remains fully open. Unsurprisingly, markets have reacted to the accelerating economic recovery, the massive fiscal stimulus, and the Fed's new monetary policy framework. Inflation expectations imputed from comparing the yield on inflation index treasuries versus nominal treasuries increased sharply from the pandemic lows of March 2020 to a peak of over 2.7% in mid-May of 2021. Since mid-May, however, implied inflation expectations have declined by 30 basis points, indicating a shift toward believing the Fed will tap the brakes on a very hot economy soon, hence avoiding the need to tighten more aggressively later in the cycle. As inflation expectations increased, the Treasury curve steepened. The mid-June FOMC meeting might end up being seen as the meeting where the Fed blinked and shifted its tone to highlight its confidence in the recovery. The June meeting was also the point where Chair Powell indicated the FOMC had talking about tapering and would begin discussing when to reduce the $120 billion per month of securities purchases currently in process. While I am entirely confident the Fed will not let inflation get out of control, I do believe markets are prematurely concluding that the Fed has reverted to its old ways and will act sooner rather than later to slow growth. I continue to believe that the Fed will be very slow to normalize monetary policy and will indeed allow inflation to run above 2% for all of 2021 and 2022. As rate expectations have changed, so too have the dynamics of the equity market. Growth stocks have been the market darling for over a decade now. In the last 5 years, the outperformance of growth versus value has been particularly notable, with a 100 percentage point spread in the performance between the Russell 1000 Growth Index and the Russell 1000 Value Index from the beginning of January 2016 to mid-June 2021. The growth value dynamic reversed early in September 2020 in the United States as vaccine progress became more evident and investors focused on recovery. It was during this time that interest rate expectations began to rise, and that investors started shifting capital to stocks that would benefit from reopening and the cyclical upswing that would result. From September 1st, 2020 to mid-May 2021, the Russell 1000 Value Index outperformed the Russell 1000 Growth Index by almost 25 percentage points. Now, multiple factors drove this significant rotation. The three most important were, number one, prior to this period, investors had very few options in terms of companies that could deliver revenue and earnings growth. With a booming economic recovery, there were a lot more choices. Number two, the divergence in valuation had become too extreme to ignore, with investors paying extremely high multiples on earnings far into the future for many high-growth companies, while paying bargain basement prices for more cyclical companies generating substantial profits now. And factor number three, discount rates on future cash flows increased as yield curves steepened, making profits far in the future less valuable than those in the near future. Since mid-May, yield curves have flattened a bit, and fears about increasing discount rates have dissipated somewhat. This has given new life to the growth stocks, for now. These equity market dynamics related to value and growth are most evident in the United States, but have also been true globally, albeit to a lesser extreme. So where does this leave investors, and what are the implications for asset allocation? The key underpinning to my asset allocation views is that I believe we are going to see the strongest economic growth in decades across developed markets, with the United States leading the pack. I also believe the Fed is not going to do anything to slow that growth as millions of workers re-enter the labor market later in 2021 as schools reopen, vaccinations are further deployed, and unemployment benefits expire. This influx of labor will help keep a lid on inflation, even while other supply chain challenges related to shipping and semiconductors are addressed, further lowering inflation risk. Now, through this period, I expect markets to increasingly anticipate inflation that is sustained at or above 2%, but not at levels that would be seen as out of control. I also expect to see a Fed that is slow to act to limit inflation for fear of anchoring inflation expectations at undesirably low levels. This all means higher interest rates. With sustained inflation of 2 to 2.5%, investors are going to be unwilling to tie up their capital in 10-year treasuries unless they can earn a positive real return that also compensates them for the duration risk they're taking. This implies a 10-year yield that rises to 2.5 to 3% over the next 1 to 2 years, implying a capital loss of as much as 10 to 15% for a treasury purchase today. Now, given that developed market sovereign debt in almost every major issuer has a negative real yield, I continue to believe sovereign debt is very unattractive in developed markets. Now, what credit is not much better, At least I can earn a positive real return at a shorter duration point on the curve in corporate debt and in emerging market debt. And hence, I would recommend allocating money into these areas until developed sovereign rates are meaningfully higher. Within equity markets, I do not believe the rotation out of stocks driven by long-dated cash flows into stocks driven by near-term cash flows is over. Moreover, I believe the market might be underestimating the longevity and strength of this recovery, and hence could be undervaluing the more cyclical parts of the market that are traditionally viewed as value sectors. Ultimately, I believe investors should focus on investing in companies that can deliver high or improving returns on capital that can be sustained at high levels. Valuation is important, but investors should also recognize that even when high-quality companies get to stretched valuations, their ability to compound earnings generally means they grow their profit into the share price over time. One facet of quality that has been underappreciated in markets, in my view, is sustainability. Investors have long focused on understanding how long returns on capital can be sustained, but in many cases have ignored other practices that are inherently unsustainable as it relates to managing human capital and natural capital. I believe strongly that unsustainable practices related to employees or natural resources fundamentally make returns on financial capital less sustainable. As governments around the world begin to tackle the existential challenge of climate change, business practices regarding greenhouse gas emissions and other topics historically considered in the realm of ESG are going to increasingly be in focus for investors. As it relates to alternative investing, I expect future returns from private equity to be lower than in the past as increasing amounts of capital chase the same opportunities. Real estate could offer significant opportunities amidst the uncertainty and disruption created in both the commercial and residential real estate markets, while also offering inflation protection if we do undergo a regime shift in the years ahead. I think investors should think more expansively about options and alternatives, and would highlight that right now, private investments in public equity, otherwise known as PIPEs, could be a very attractive opportunity. There are over 420 special purpose acquisition corporations, or SPACs, seeking to take companies public through acquisitions. In over 90% of the cases where a SPAC does take a company public, they require PIPE capital to complete that acquisition. Given the negativity in markets about SPACs, PIPE investors have seen their leverage increase significantly, to the point where PIPE investors can force renegotiation of acquisition terms and extract SPAC sponsor economics in some cases. In summary, the economic outlook is bright. Inflation is highly likely to remain elevated in 2021 and into 2022 as well. While it's too early to say inflation has shifted to a substantially higher level on a sustained basis, it does appear much more likely that inflation might remain in the 2 to 2.5% range for the next few years. If that is the case, I expect meaningful steepening of the U.S. yield curve and substantial shifts in equity market allocations. As a result, investors need to reassess their asset allocation to determine how to inflation-proof their assets. I believe shortening duration and rotating capital into credit and out of rates in the fixed income part of portfolios is a good plan, despite fixed income itself being quite unattractive relative to equities and alternatives. Within equities, I expect the rotation out of highly valued stocks driven by long-dated cash flows into companies generating high returns on capital now to resume after the brief hiatus of late May and June once yield curves begin to steepen again. I recommend focusing on quality companies that can deliver sustained high returns on capital while embracing sustainable practices related to their employees and natural resources. And finally, in alternatives, I would de-emphasize private equity in favor of real estate and would broaden the scope of potential investments to consider new options, such as PIPEs arising from SPAC acquisitions, as a new way of generating capital appreciation. Thank you for sharing your time with us. We welcome your feedback and hope you found this edition of Lazard Insights valuable.